Hello everyone and welcome to the world of finance. This will be your first lecture on financial management. So you may be CA or CMA intermediate students who is about to learn financial management maybe for the first time, and that gives me an immense opportunity that I should be able to help you out in this journey of learning financial management. So we will be beginning today with basics of financial management. Getting started with what exactly financial management is all about. So as of now, I would instruct you not to write anything because I will provide you notes in very systematic order. Just try to listen to me and try to understand everything. Okay, just try to listen to me. I will tell you when to write notes. So basics of financial management will begin with the meaning of financial management. Now I don't want you people to put your brains in understanding those complex formal definitions of financial management. It will not solve the purpose. If you need to understand financial management in one go in terms of what exactly is financial management, I would say you should simply understand that financial management is a study about two aspects. Number one, how do you arrange your funds, and number two, how do you utilize those funds. That means what two aspects are mainly going to be discussed in financial management: arrangement of funds and utilization of funds. So if you understand how you will arrange funds and how you will utilize funds, from where you are going to arrange funds and at what applications you are going to utilize these funds, that is all financial management that it talks about. So what I want you all to understand is it is all about arrangement and utilization of funds. Now when we take decisions in business, so financial management of course will involve lots of decisions, right? Decision making will be part of any management study. When you learn something as a management, taking decisions, making plans, executing those plans, implementing the outcome of those decisions become your entire operational area, correct? The implementation part. But primarily there will be a planning involved and there will be a decision making involved. When we take decisions, there is always an impact of that decision. The moment we take a decision, there will be impact of that decision. Impact of certain decisions may go in our favor, impact of certain decisions may go against us, depending upon how efficiently we have taken that decision. Sometimes you would have experienced that after taking a decision, you keep repenting that why did you decide like this, but you cannot do anything because the decision has already been taken. For example, I have realized some students in my career, I have seen some students who after joining CA course, they keep wondering why did I do this, and they are just not happy with that decision. On the other side, I have seen some students very happy with this decision. So decision making of any type is going to show its impact. That impact could be a short term impact or it could be a long term impact. Suppose, because you are my student attending my classes, just imagine that one day I have approached to you for some help. I have asked you that please get 1 kilogram of apples for me. I am giving you the amount. You please buy that fruit and bring it for me. Now the fact is, to the student whom I assigned this activity, that poor student did not know how to select good quality apples, and that student simply went to a fruit shop, purchased 1 kg of apple randomly without even knowing the quality, and when he got that fruit to me, I realized that the quality of those apples was not good. Now tell me, will you consider this as a right decision or a wrong decision? So it was a wrong decision. Whose wrong decision? Student's wrong decision or my wrong decision? It was my wrong decision, because without even knowing whether the student is capable of doing that task or not, I have simply assigned that task. But what do you think will be the time impact of this decision? This decision taken by me was a wrong decision. It will affect me for one day, a few days, a month, a year, a decade, or entire life. This wrong decision will have its impact maybe only for 2 to 3 days until I get finished off with that stock of apples. Making sense to you? Okay. So, on the contrary, if I have to buy a property, if I have to buy a house property, say at Chennai, I want to buy a house property. If I give you bags of money and ask you to go and buy property for me, and you have no idea where and what kind of property you should buy for me, and you end up buying a wrong property for me, what will be the impact of that wrong decision for me? Few days, few months, or a big long time, maybe in terms of good number of years. That decision will impact me for a long term. Can we agree that impact of a decision could be either a short term impact or could be a long term impact? So, in accounting and finance, we learn how to distinguish something that we can identify as short term and what we can identify as long term. There is a line of demarcation. Do you have any idea what could be that line under which everything falls as short term and beyond which everything goes as a long term? Do you have any idea? The correct answer is, of course, a period of 1 year, or you can call it a period of 12 months. Anything happening within next 12 months is considered as short term. Anything happening beyond a period of 12 months will be considered as long term. So 1 year is the line of demarcation, and good thing is the entire world follows this protocol. So it is not this way that in India we have long term and short term distinguished by 1 year. The moment you go to France, the long term and short term distinguishment is made by 5 years. You go to the United States and long term and short term distinguishment is made by 3 months time. This is never going to happen. The world as a whole follows this simple understanding that what happens within 12 months is short term, what happens beyond 12 months is long term. Are we clear with this whole matter? If yes, then what we can understand further, that we have to take two types of decisions in financial management. Typically 2 types of decisions. What are these 2 types of decisions? Decision number 1 is arrangement of funds, that is how to arrange funds. We call this kind of decisions as financing decisions. I told you, don't bother to write anything. I'll give you systematic notes as and when the time comes. Okay, just keep listening to me, just keep listening to me. So we have financing decisions, as in decisions with respect to arrangement of funds, decisions with respect to arrangement of funds, which we are identifying as financing decisions. Then we have decisions with respect to utilization of funds, where we are utilizing our money. When we utilize our money and we acquire some assets, we are actually investing our money. So those decisions where we invest into certain assets, those decisions are called investment decisions. So I told you few minutes back that financial management is about 2 important aspects: arrangement of funds and utilization of funds. When I say arrangement of funds, it is basically arranging funds through various sources. That is what we put in the category of financing decisions. And when we talk about utilization of funds, we are putting our money into use. That is basically an investment decision. So, broadly speaking, we have three types of decisions to be discussed. The third decision, I will not speak about that thing right now. I am just sticking to two decisions, that is financing decisions and investment decisions. Now, when we talk about investment of funds and we have invested funds for a short term, suppose I have acquired an asset which is supposed to be there with me for just 3 months time. In 3 months time, I am going to sell it off. The nature of that asset is considered as a current asset. And when I buy an asset which is supposed to stay long with me, I will call that asset as fixed asset. So can we agree that when I invest my money, I will end up purchasing some asset or I will end up acquiring some asset? That asset could be either a short-term asset or a long-term asset. Short-term assets are basically identified as current assets. Long-term assets are identified as fixed assets. So in accounting and finance, we have categorization of assets as fixed assets or non-current assets, and the other category of assets as current assets. So the way you distinguish assets as non-current assets and current assets, non-current assets are typically all long-term assets. When you acquire building, when you acquire plant and machinery, when you acquire furniture, when you acquire some equipments, all these are long-term assets which we generally identify as fixed assets. On the other side, when you acquire inventories, inventories means stock in trade. When you have purchased raw material for converting that raw material into finished goods, or when you have purchased finished goods which you are supposed to sell it within 2 months time or 3 months time, in that case these assets are not long-term assets that will be staying with you. These are basically short-term assets and so-called current assets. So you have to understand whether that asset is going to stay with you for a long term or for a short term, and accordingly you decide. So investment decisions will be classified into two categories: long term investment decisions and short term investment decisions. I repeat, long term investment decision and short term investment decisions. Likewise, suppose we are arranging funds, we are taking financing decisions. I have issued debentures. You know what is the meaning of debentures, right? You know what is the meaning of shares. You would have learned these things at foundation level. Shares and debentures are securities issued by a company. When the company wants to raise its equity capital, it will be issuing shares, that is equity shares, to arrange that money. And when the company wants to raise loans, it can either go for a bank borrowing or borrowing from any NBFC or borrowing from any private money lender, or even by issuing debentures. Debentures are basically breakup of companies' borrowings into short denomination of instruments. And when you are raising debentures and the life of that debenture is suppose going to be 10 years, is it a short term funding for you or a long term funding for you? Obviously long term funding. When you are issuing equity shares will stay with you throughout the life of the company, right? Until the company is wound up, equity shares will be there into existence. As a result, it is again a funding on a long term basis. However, if you want some money for a very short period, and under a promissory note you have raised a short term arrangement and you have given a counter promissory note. For example, you borrowed a sum of rupees 10 lakhs from someone just for 3 months, and you have written a promissory note that I shall pay you rupees 10 lakhs after 3 months for the amount that I have received today, and you have given that promissory note signed. Now that promissory note, do you agree it is your liability? It is your liability because it is indicating a payable arising because of that promissory note. The nature of that liability is going to be squared off within a period of 3 months. In that case, the nature of that liability is obviously a current liability, correct? it is a current liability. So whether to arrange that short term amount by short term bank borrowings or through that promissory note or through a bill of exchange could be your decision. Those decisions will be short term decisions because the impact of that decision will not go beyond 3 months in this example. In that case, the nature of the liability that is arising is not a long term liability, it is a short term liability, and in accounting and finance all short term liabilities are termed as current liabilities. So when we are going for raising finance, we will have financing decisions of two types: long term financing decisions and short term financing decisions. So long term financing decision is a separate category and short term financing decision is yet another category. So let me quickly give you a recap of what we have discussed by far. Financial management itself is a study about two aspects in finance: arrangement of funds and utilization of funds. When we take decisions in regards to this aspect, that is both of these aspects, arrangement of funds and utilization of funds, the decisions which are arising with respect to arrangement of funds, we identify these decisions as financing decisions, and the decisions that are arising with respect to utilization of funds are classified as investment decisions. So we have financing decisions and investment decisions. Thereafter, we have all the decisions to be classified into two categories: short term and long term. So now we have four categories of decisions: long term financing decisions, long term investment decisions, then short term financing decisions and short term investment decisions. Now short term financing decision will create liabilities which are current liabilities. Let me tell you one thing very clearly: when you are having a financing decision, the outcome of that decision is raising funds, right? When you raise funds, you are actually arranging money by borrowings typically, correct? So when you are arranging money, it will create a liability for you. When you are utilizing money, it will create an asset for you. For example, today if you buy a calculator, use your brains and tell me, today if you buy a calculator, is it arrangement of money or utilization of money? The obvious answer is it is utilization of money. But do you notice one thing? Because of utilization of that money, what you create for yourself is an asset, correct? So when you utilize money, you create an asset. When you are arranging money, you create a liability. So when you utilize and arrange money for short term arrangement of funds, that is short term financing decision, will lead to a liability known as current liability, and short term investment of funds will lead to an asset that will be a current assets. That means when you are taking short term decisions in financial management, short term arrangement of funds or short term utilization of funds, that is in other words short term financing decisions or short term investment decisions, what you end up creating is current liabilities and current assets. Current liabilities are arising because of short term financing decisions, and current assets are arising because of short term investment decisions. Now let me tell you, are you aware of one thing, that the net amount of current assets and current liabilities in finance, it is termed as working capital? If you have ever heard of this, it is termed as working capital. So managing your short term liabilities and managing your short term assets means managing your current liabilities and current assets is typically called as working capital management. Now if you could see on this entire hierarchy that I am explaining to you, your syllabus has been designed exactly in these lines. So what do you have in your syllabus? If you look into, you have a topic called long term financing decisions, and within that you have various subcategories like study of leverages, study of cost of capital, study of capital structure, all this come under long-term financing decision. When it is long-term investment decision, you have a very important segment in financial management termed as capital budgeting. So long-term investment decision means basically you are making a plan for a capital expenditure. It's a long-term investment, right? So you are making a plan for a capital expenditure, which we identify as capital budgeting technique. Thereafter, you have short-term arrangement of funds and short-term utilization of funds, that is short-term financing decision and short-term investment decision, which is giving rise to current liabilities and current assets. And we have seen that the aspect of managing current assets and current liabilities is what we call as working capital management. That is the third important segment in your syllabus. Some time back I told you that there are 3 types of decisions in finance, but we have discussed only 2 of them. Correct? The third type of decision I did not talk about. The decisions that we have talked about were financing decisions and investment decisions. The third type of decision is dividend decision. Very important decision in financial management. Do you know what are dividends? See, the shareholders of the company who have contributed their capital, they are having rights on the profit that the company is earning. So in case of a sole proprietor, you would have learned one thing, that if the proprietor is earning profits in the business, a portion of that profit will be withdrawn by the proprietor as drawings. In this matter, when the shareholders of the company, who are owners of the company typically, when they want the profit to be withdrawn, this is done by an activity called as distribution of dividends. So for a company, this also becomes a very important decision, that how much dividend the company should distribute. Should it distribute entire amount of profit? Should it distribute 80% of profit? Should it distribute 50% of profit? Should it distribute 20% of profit? Or for this particular year, because company is in important situation, company is in need of funds, why don't company simply decide not to distribute any dividend for that particular year? Now all these aspects are also decision making situations, and these decisions are classified as dividend decisions. Now one thing good about dividend decisions are not classified into short term and long term, because dividend decisions, every year the company has to take this decision. So you will not be classifying these decisions into short term and long term, but other decisions you will be classifying into short term and long term. So if I now tell you the complete hierarchy of different types of areas of financial management, so we have financing decisions, investment decisions, dividend decisions. Financing decisions classified into short term and long term, investment decisions classified into short term and long term, dividend decisions just dividend decisions. So now we have 5 categories. What are those 5 categories? Short term financing decision, long term financing decisions, short term investment decisions, long term investment decisions, and dividend decisions. Now the study of long term financing decision is a separate topic in your syllabus. Study of long term investment decision, that is all about capital budgeting, it is a separate topic in your syllabus. Then study about short term financing decisions and short term investment decision can be clubbed together, which is giving rise to current assets and current liabilities. This can be clubbed together under the title working capital management. And then we have a separate chapter in our syllabus titled as dividend decisions. So I have just explained you that what is there in the meaning of financial management. It is a study about arrangement and utilization of funds, even distribution of dividend. Don't you agree that it is another type of utilization of funds? Company is utilizing funds, but company is not making an investment, it is distributing its money. Therefore, when a company is utilizing its funds, you have to look into whether it is making an investment or it is distributing dividends to its shareholders. That is why investment decisions and dividend decisions both arise as decisions from utilization of funds, that aspect. Now, apart from all this, we have one more very important area in your syllabus, and that is analysis of financial statements. Because when you have to take any decision and when you have to observe this from the shareholders' viewpoint, shareholders will analyze the company's financial statements and they will draw their own interpretation about the performance of the company, about the standing of the company, about the profitability of the company. Lots and lots of analysis can be done through company's financial statements, and that aspect we are going to learn separately under a very important chapter, that is analysis of financial statements. Because this is done through accounting ratios, you may title that chapter as accounting ratios, and because it is financial analysis done through accounting ratios, many people tend to call that as ratio analysis. How you title that topic, it really does not matter, because the meaning and message conveyed is one and the same.